Hello, welcome to Any Answers Answered for January 2018. Happy New Year to you all. I hope you are working steadily through tax returns. A couple of questions we've been asked this particular month. We start with a question, Tim, from somebody called TikTok relating to residential property company. I have a client company that owns several residential properties. This year, they have noticed that 2 of the properties are being let to the director's children for a lower than market rate, around about 2/3 of the market rate. My thoughts are that this will be a benefit in kind on the director, personal use of company asset. The children are obviously not minors, but are still connected persons. Any pearls of wisdom?
Yes, and quite right to raise the query because, as is well known, if a company provides a benefit to a director or to a member of the director's household, then that benefit is assessable on the director. And the director's household includes their family, guests and servants. Well, the 2 children would indeed count as members of the director's family, and so if there is a benefit because of the occupation of property owned by the company, it'll be assessable on the director and should go on the director's P11D. Of course, being accommodation, it's going to be taxed under the special rules that apply to accommodation, where we will need to assess it by taking the official rate of interest on the excess of the cost of the property over 75,000, but we'll be able to compare that with the actual amount payable by the children.
I think that's absolutely right. I just want to highlight that actually TikTok had said, I think it's a benefit in kind. We agree with that. And then has said personal use of a company asset. Well, that's the 20% of the value test, isn't it? It's
not for accommodation.
And it's not that. It is an accommodation charge.
Yeah.
It is not personal use of a company asset rule,
Correct.
Which is a different rule. So it is based on the accommodation. And as you say, there would be an adjustment for anything they have paid. But it's the sort of thing that could easily be missed, actually, when working through. Particularly.
It's interesting that only one of the accountingWEB community has posted an answer or a response to this post, and that is the omniscient Ms. Levin. And Ms. Levin says, how much are they worth? Answer, between 200 and 250,000. Now, the relevance of that, as Ms. Levin points out, is that the annual tax on enveloped dwellings, ATED, could apply if a company owns residential property that is valued at more than $500,000. And so because these properties are worth less than $500,000, few, as Ms. Levin points out, no ATED at the moment, and they don't need to consider the valuation for another 5 years. But if in the meantime, the threshold for ATED is lowered, and that is what has happened over the last few years since it was introduced, this could give rise to a charge on the company. And at the $500,000 level, the company would have to pay ATED of I think 3,500 is the figure there. And I note that the poster TikTok says that the company owns several residential properties. So presumably TikTok has reviewed the value of all of those properties from the perspective of ATED.
Okay. Second question is to do with a pension lump sum. An excellent question, I think, this one, from Caroline Bates. I have a client who has taken around £110,000 as his 25% tax-free cash from his pension. He already regularly uses the normal expenditure out of income allowance, but can he include this sum in, say, the 2-year period from when he received it for this purpose, or do the revenue deem this to be capital? Of course, the key test, one of the 3 key tests with normal expenditure out of income, is that it's out of income.
Yes, Section 21 of the Inheritance Tax Act 1984 is the normal expenditure out of income one. At the time of recording this, nobody has posted a response to this question, but I think it is clear cut. And income for this purpose will not include a lump sum payment from the pension fund. The poster is right, the revenue manuals do refer to pension payments, but what they mean there is pension income. And so regular annual income from a pension would count. But in preparing to answer this, I did find an article in Taxation magazine over 5 years ago, in fact, but still holds good. And when looking at the definition of income, Mark McLaughlin wrote the article in Taxation in 2012. He makes the point that the capital element of a purchased life annuity bought since November 1974 is not treated as income for the purposes of Section 21. In addition, annual 5% withdrawals from a single premium policy, the chargeable event type policy, are generally considered by HMRC to be a receipt of capital as opposed to income, and therefore cannot be taken into account. And the same applies to receipts from a discounted gift scheme. Now, I would certainly take the view that the 25% tax-free lump sum from a pension counts as capital, not income. I'm not so sure I'd agree with the 5% withdrawals, because it's really an accounting question. And I think that if somebody has, as my mother did 23 years ago, sent £12,000 to Scottish widows, and ever since they've sent her 600 quid a year, the 5% tax-free, I think that does count as her income in accounting terms. And so I would disagree with that part of the article, but I would agree that the 25% pension lump sum figure is, in accounting terms, capital, and hence wouldn't count as income for the normal expenditure out of income relief.
So the person would presumably then have to live 7 years. That would be the only way of getting around the transfer to another family member.
What the poster was hoping to do was to support higher payments over not just that 1 year, but 2 or 3 years, I think, but funding them with that lump sum from the pension fund. And yes, each of those would then be a potentially exempt transfer, which would then need to be survived for 7 years to escape IHT.
Okay, hopefully useful. Hopefully we covered the various bits and pieces there that were that the questioners were after. If you have a question, do post on Any Answers, and perhaps next month it will be your question that Tim and I discuss on Any Answers Answered. But for this month, bye-bye.